Good evening and welcome viewers to The Link. We thank you very much for being loyal, and we want to keep our side of the equation. Bring information that you can use and opportunities around money and things to do with your money, business, investment, and such things in that realm. Tonight we're discussing mortgages. Probably I've not heard it for the first time. Many of you are taking up mortgages because there's a lot of property coming up, condominium especially. These flats that are built up, and the prices sometimes are priced in dollars, but yes, brought back to shillings. Many of the young generations have an uptake for that, and they go to the banks and they get money to acquire these mortgages. However, we're discussing and asking ourselves how to avoid your housing mortgage becoming a headache, so that it's there's value for you and you don't have headache. And tonight my guest is Mr. Daniel Babonerere, who is a consultant in the banking sector for over 20 years, but also operates Banner Consult. He's a consultant in that space. Daniel, welcome back.
Thank you. Thank you, Sam. And good evening, viewers.
Most known for what your banker will not tell you. Maybe we are also doing a little bit of that. But let's take the first question. Maybe you can tell us briefly what's the mortgage, but the question I want to ask, what homework do I need to do before deciding to take up a mortgage?
Thank you, Sam. And as we have always talked about what your banker won't tell you, at Banner Consult, we pride in actually sharing that information freely. Yeah. The financial literacy, which not that the banks don't want to tell you, but it's not their core business. The banks are sometimes too busy, sometimes they are over-regulated, sometimes the banker you meet is not the one authorized to give you the information, and maybe even is not the authorizer. So when they don't tell you some of the information, it's not that they don't want to tell you. But we are in an open space, and this is what we bring you so that you can always enter anything understanding what you are going into.
Informed decisions.
Informed decisions.
Yes.
And the last time we talked about Kampali, we don't want to go back into it, but it's self-assessment, not waiting for the bank to be the one to assess you, but to assess yourself and even know where you can fall in, and when as we go along, we shall share some of the things. Yeah. And then the other one is the formula which we all learned about in primary school. How you derive interest or the money you pay. The principal times rate times time.
Yes.
And you should know which of these three you should play around with to end up with the amount that you are going to pay that is so comfortable with you and so comfortable with your objectives.
Okay.
Now, at the end of the day, the overarching one is that, are we approaching this with a fear mentality or with a gain or rich mentality, or poverty mentality versus rich mentality?
I think the young people who go for mortgages are thinking opportunity. And that's why we are saying watch out. Let's start with what is a mortgage.
A mortgage, as we had talked before, is made of two Latin words.
Yeah.
Mort and gage.
Yeah.
Mort means dead. Gage means pledge.
Okay.
Now, this is a mortgage in two ways. You can look at it in two ways. It does not expire until it's extinguished.
Okay.
Whether you die or you are alive. It's a mortgage. And unlike a caveat has fixed time. When it reaches, say, 6 months, the reason you had put it there and you have not proved it, it expires.
Okay.
But a mortgage does not. So the way it dies, why it's mortgage, is that it dies when you extinguish your liability.
And today we're talking about housing. So does that mean, Daniel, from your definition of mortgage, I go to the bank, they give me money, I buy the property, but it remains property of the bank until I pay back. Is that correct?
It actually never belongs to the bank. It remains your property, but you have a deed. In our local language, we have omusingo. Omusingo does not become the property of the person who has lent to you, but it's your property, but it is staked. Wajisinga. you pledged it.
Okay, to get the money.
To get the money.
In the interest of time, let's now discuss mortgages can have problems. Even other loans can have, but mortgages can have their own problems. What do I need to do? And you mentioned it earlier, some of this, like assessing yourself before I take up a housing mortgage. Because normally they tend to be 15, 20 years.
Yeah, thank you, Sam. And this is where we said the overarching mindset. A mortgage normally takes much longer if we are talking about like a personal mortgage, because you need to know actually the one you are taking. Is it a personal or housing mortgage, or is it a commercial mortgage?
Let's focus on the housing.
The housing one is that you are taking it for a long term.
Yes.
And in most cases, you are the one staying in the house. And now it means the source of income and the asset you are acquiring are two different. So you have to question yourself, am I acquiring a liability or an asset? Okay. Majority of the times when we acquire, in financial terms, or in business sense terms, our housing mortgage where we are staying is not an asset, it's not a business asset. But you can take it as an asset in a common man's language, that is your own property. But you see now it's not a source of income to pay itself. Okay. And in some of the things that the best loan to take is the one you are not going to pay. Okay. Meaning someone else is going to pay it. But here you're going to pay it for an asset which does not generate income. Okay. And if you compare it with the, let's drop there a bit, with the commercial mortgage. Yeah. The commercial mortgage, you will calculate and see, because it's a business, you will calculate and see, if I put in 100 million, now the dictum is always 1%, can I get 1 million plus my profit per month? If you can't get 1% of revenue from that property, it means you are basically fasting so many things to pay it up. So the housing mortgage then can take on the same dimension. I can acquire a property, maybe a house, on a mortgage, but I put it to rental. Yes. That becomes different. Now when you put it to rental, that's when you cut out so much of emotions and you go into calculations. Okay. That's why I was giving us the principal times rate times time. Now if I'm paying back 1.5, but I'm getting out 1 million. It means I'm subsidizing the tenant. Okay. But that calculation never comes when I'm the one sleeping in the house. Let's deal with that one. I'm sleeping in the house. Yes. I'm taking a mortgage because I want to live in Naguru, Kololo, Ntinda, Chuatule, and so on. First of all, you said that I need to calculate. It's not an asset, it's a liability. That's number one. That means my income has got to be sustainable. What else do I need to keep in mind before I start to want to take? That's what I told you. Let's again use like for example the Campari in brief, in abridged format. Yes. Your character. You must get your character and say, and the character. Am I ready for this liability? Okay, psychologically. Psychologically. Okay. Because if you are not, and then you forget after about 2 years and forget that you are actually still... You are paying for 20 years. Yes, your equity in that property has not yet grown to call it your house. You actually better psychologically call it someone else's house. Basically here what you are trading is, instead of staying in Sam's house and I'm paying rent, I'd rather pay the bank and it becomes mine at the end of the day. Because if I rent for 20 years in someone else's house, it will never be mine. That's the mindset. That's the mindset. It's not my property yet. Yes, but you are better off in the mindset knowing that now this property, since your equity is not yet over 50%, it sees someone else's house. So my takeaway from that is that if I am in a mortgage, if I'm used to taking short-term loans of 3 years, and this is 20 years, I better be sure psychologically I can deal with 20 years. Yes. As opposed to the 3. That is, you see in the character, sometimes some of it will make it more judgmental. Because if I am 50 years old and I'm now taking a mortgage of 30 years, it means I will be 80 by the time it ends. That's deadly. That's deadly. So it would be good if you calculate it early and take that mortgage when you are younger. In our cultural setting, in where I come from, is that actually you are not allowed to marry a wife in your father's house. In most of our cultures, that's how it is.
When you're still home.
Part of getting married would be to actually construct a house. And using local materials would do. But the different setting here is that you are using other materials and you are using other people's money.
Let me interrupt you there. We're going for a short break. The conversation is still hot. First of all, psychologically. Don't just jump and get excited and jump into it. Daniel was telling us. But we're coming back after this short break to tell us more of the homework you need to do before you jump into a mortgage so it doesn't become a headache for you. Don't go away. Welcome back from that short break. When you went away, we were still talking about homework to do so your mortgage does not become a headache for you. And in studio, I have Mr. Daniel Babonelere with Banner Consult, and is a consultant for 20 years, more than 20 years in the banking sector. And we're discussing how to avoid your housing mortgage becoming a headache. And the first thing we said, assess yourself. And we're even at the level of psychology. If you are used to taking loans of 3 years and short term, and then you jump into 20 years, terrific. You need to do your homework. If you are 50 years and you're going to take a mortgage of 30 years or 20 years, you're going to be 70. Does that make sense? Daniel, let's continue the conversation.
Yeah, thank you. And since this is just a conversation, it's not a lecture.
Yes.
And because we need to relate with whatever we are saying.
Yes.
I just want to take you in sharing about 2-3 examples. We talked about the emotional and the calculation.
Yes.
We all don't have to be class A students to do that. I use people in town here in Kampala, people who impressed you. You are a banker, but you just learn a lot from those clients. There's one client who actually used to have an NGO job. So every contract, he determined that I will always get a house out of it.
Okay.
So you'd come to the bank, take the loan. By the time they renew the next contract, he makes sure he has finished it.
Discipline.
Discipline. He acquires, looks at another one, he acquires, he takes home his land title. Psychologically, he's already settled. He's out of the water. I remember him taking more than 5 mortgages and paying back. Because he's settled. He's not worried that he's going to be evicted. There is another gentleman who actually would use his own money to put up a structure very rapidly after negotiating with the bank. He has said, I'm going to take 500 million. He goes and uses his own money because we have already agreed, we have not yet disbursed. He's the one who has said don't disburse it. He puts his money, the building runs very fast, people book. Now he starts using tenants' money. People book. It was here in Kampala. People book. Then by the time he comes to the bank to take the money that was approved, he already needs, he now needs only 250.
So he has already reduced the exposure.
He has already used other people's money. Then there's a young man also who came, he challenged my thinking. He came, he wanted a loan of 250 million because the loan a bank would take your age of retirement minus your age, you are right, the age that time. He was about 25, I think. So he could qualify for 250 million, though his salary was low. So he said, I'm going to go and buy land in Luwelo. That land is going to, by end of 5 years, the price is likely to have doubled. So even if I'm no longer working, I can sell half.
Contingency.
And I'm sorted.
Contingency for income.
Even if I'm still working, I'll choose and sell half and continue with life.
Because of the long-term nature, the contingency, you don't know what's going to happen in time.
Another gentleman was also having this big construction, but he first shared his plan and the location, and he got almost the same as the other one. Got supermarkets, got banks who were the anchor tenants, and every other business person wants to be where that person, the big ones are. And basically that is it. So, to borrow the model, I don't know if you're saying, if I stay in the house, which is the mortgaged house, I need to be more careful. Now, we are discussing what your banker won't tell you.
Yes.
The bank is not going to go and start telling you that you are investing with a poor man's mindset.
Okay.
Most of us, including myself,
yes,
I've made those decisions. You take a loan and you are paying, and the asset is not paying you. Now
you are getting income elsewhere to pay for the mortgage.
Yes. Now the bank is not going to tell you that you must have tenants in that place. That is your decision.
So, what do I do then if I want to acquire a condominium and I don't have money and I want to stay in such a house? I can come for a mortgage but bear the risks.
This first time what we were dealing with was the character. Now we said the character and the emotional upbringing. Now we bring in the calculation, ability to pay.
Yes.
Where am I going to pay to get this money?
For 20 years.
For 20 years. Am I sure I will be employed? But most of us use emotions because we have this feature. I drink with Sam, and Sam lives in Naguru. I must also have it in Naguru.
Not knowing COVID will come.
Condominiums, they look so good. Other people have taken them, and because you drink together, you play. You also go there.
Take away.
You have
don't
to
make decisions based on feelings.
Yes.
Let's take the last question. Is mortgage insurance foolproof? People say, I'm covered by the insurance company. And we have about 4 minutes.
On the same company, we remember last time we quitted insurance to collateral or the spare tire. Insurance is just like that. It's collateral, it's a spare tire.
Yeah.
Now, again, in tandem with what we have been discussing, you also have to make insurance work for you. Because why you are putting the insurance is answer all these questions, A, B, C, D. What if I'm not there? What if I'm dead? What if I lost a job? What if I no longer want the property? What if the property in that area is no longer fetching good rent? Now, the insurance is catering for me in case I lost a job, in case I died, my inheritors don't have to suffer. So it should not be taking on insurance because it's demanded by the bank. You could actually come in with your own insurer and say, because I have A, B, C, D benefits, use the insurance to actually increase on your benefits. A, B, C, D benefits, I'm entitled to it. And then follow up. Follow up. Because the bank has people who follow up. Sometimes they may not actually follow up. And then they wake up to assert an article you signed in your agreement. And because you are also not following up, because you don't have any other benefits arising out of that. So that is why we say you have to also put in that calculation. Most of us don't like calculating, including myself.
Quick question, Dan. Does insurance cover joblessness, or insurance for mortgage? Does it cover joblessness, loss of job, or does it cover only death and disability and permanent disability? Do we know? There
is no one size fits all. Probably that one will come with the insurer guys, and they give you all the categories they give. But actually the commonest, aside of mortgages, is the one which is like on salary loans. Most of them insure death and disability. But majority of the people sign and believe it covers even joblessness. Then there is another one you take which covers even that part of joblessness, and since you are in an employable age and skills, then you take it like for 6 months.
They give a time frame when you are jobless.
Mostly 6 months.
Not perpetually.
Yes, not perpetually. Yes. So you need to know exactly what it covers. You read through. If you can't read through, you know the jargon in all these things. Ask your consultant. It could be a lawyer or a financial consultant like some of us, or an insurer. Yes.
Okay. Takeaway, insurance does cover. However, you need to know what you are covered. And the biggest risk for me, Daniel, apart from dying, which is obvious, and maybe disability, is this joblessness, which can come on you anytime.
Yes.
And the insurance company might just cover you for only 6 months, at best 12 months. And that means after that, the bank is going to come for your property if you're not careful. Am I right?
You are very right.
Okay. I wish we could continue the conversation. I was just getting heated up, but now I need to calm down because time has run out. We hope we added value to you tonight on that issue. If you're going to do mortgages, do your homework so that it doesn't become a headache for you. Are you able to pay for 20 years? The psychology and Daniel Sold, the calculation. That was the link. Thank you for joining us tonight.